At Ground Truth, we take the money strategies the internet sells hardest and we test them on real market data, all 23 years of it, including the companies that didn't survive. Today, it's an options trade, sold as income, high win rate, capped loss. The pitch comes with a monthly recap from an options trader named Tom King, 7 trades, most of them winners, a few $1,000s up. And it comes with 3 promises. It wins most of the time. Your loss is capped at 2 times what you collect, so the math is on your side. So we ran that trade 5,742 times across 23 years of survivorship-free market data, including the companies that later cratered and got delisted, so that when we tell you how often this trade goes wrong, the number counts the ones that aren't around to be counted. It wins 4 times out of 5. That part is true, and we will show you why. Add the trades that lost the way the pitch says they will, and 96 trades in every 100 did what it promised. This episode is about the other 4. And about the strangest number in the study. 985 trades lost while the market was open and moving normally, and in every single one of them, the stop got the trader out at exactly the price he was promised. Not approximately. Exactly. Hold on to that because it is not the reassurance it sounds like. And if you have just watched a recap like that one, and you are about to pay for the room it advertises, the whole decision comes down to one number that is never in the recap. We went and got it. 3 questions. Keep them. 1. Is the win rate real? 2. Is the loss actually capped at 2 times the way it's sold? 3. After the costs nobody prices, is there anything left? This is the audit of the capped loss income trade. This is Ground Truth. You want income? Stop guessing direction. Here's the trade. You pick a good stock, you sell somebody insurance on it, way below where it's trading. They pay you cash today. 2 weeks later, the stock is still standing, the insurance expires worthless, and you keep the money. You win 4 times out of 5, 5 times out of 6, and if it does go against you, you're out at 2 times what you collected. That's it. That's the whole risk. Small wins over and over, and a loss you already know the size of. Quick note. This is education and entertainment, not advice. We test ideas. We don't tell you what to do with your money. That is the pitch, and it is a good one. The real name for it, and you will see it written this way, the 112. Some people sell it as the bear trap. It's a put ratio spread. A put is the insurance policy he just described. It pays out if the stock falls below a set price. This trade uses 4 puts. You buy 1 put, you sell another one right next to it. That pairs the piece with a floor under it. Then you sell 2 more, much further down, and those 2 have nothing behind them. The word for that is naked. 1 bought, 1 sold, 2 sold. 1, 1, 2. That is where the name comes from, and those last 2 are the entire subject of this video. And the first claim is true. Before the numbers, the shape of it. Suppose I bet you $1. It does not rain here tomorrow. I will win about 9 times out of 10. My win rate is 90%, and I have no skill. I just picked a bet that usually wins. That is what this trade's win rate is telling you. Not that it is good, that it is shaped that way. It is not a trick. It is arithmetic. When you sell something that only pays out if a stock falls 13 to 15% in 2 weeks, that is where our test put the strike, and his own example sits a little further out. You are going to win most of the time, because stocks mostly don't do that. A high win rate here isn't evidence the strategy is good. It is a description of the structure. Any strategy shaped like this one wins most of the time. So the win rate was never the load-bearing claim. Here is the one that is. Your loss is capped at 2 times. Everything else, the income, the compounding, the sizing lecture, and the recap videos, rests on that one sentence being true. So let's find out what it's actually made of. A stop loss is sold to you as a wall. A hard line your loss cannot pass. It is not a wall. It is a tripwire. A tripwire fires when something walks past it, when the price moves down through your level while the market is open and somebody is standing there willing to buy from you. That is most days. On most days, a tripwire is indistinguishable from a wall, and that is exactly why nobody notices the difference. Now, the recap video that started this, from a trader named Tom King. 7 trades in 1 month, 6 winners, 1 clean loser at right about the advertised 2 times, a few $1,000s up. We are not disputing a single number in that recap. The sizing advice in it is correct, and it is more disclosure than most of this genre offers. 7 trades is not a dishonesty problem, it is a sample size problem. So, before we ran anything big, we ran the small version. First question to the machine. Suppose the thing that actually hurts this trade shows up about 1 time in 24. Hold that number, because we haven't earned it yet. How often does a 7-trade month contain exactly 0 of them? About 3 times in 4. 3/4 of all honest 7-trade months look like a clean 7-trade month, not because the trader hid anything, because 7 is a small number, and the thing you need to see is rarer than 7. So, we didn't want a month. We wanted every month we could get. Here's the machine. We ran it 2 ways, because the contrast is the whole point. The first is his own 6 names, the hot, high volatility momentum stocks. This trade is actually sold on 6 years of them, because that is how long some of those companies have existed. The second is what we call the honest universe. It is the same character of stock drawn from 22 years and built point in time. That means each month only gets to know what was actually knowable that month, so nothing is picked with hindsight. It contains the thousands of hot names that later cratered, got taken over, and got delisted, kicked off the exchange and gone. His 6 names flatter the strategy by construction, and we ran them anyway, because that is the list the pitch is arguing from. His rules, not ours. 14 days to expiry. Take the profit once 90% of the credit is banked. Stop at 2 times the credit. One word there is doing all the work. The credit is the cash the buyer hands you up front for selling the insurance, and it is the unit every number in this video is measured in. We size every trade to collect $1,000 of credit. So his stop sits at $2,000, and when I say a loss ran 4 times the credit, I mean $4,000. We also price the options generously in his favor, which means a fat credit and a fat cushion. When we had a choice, we took his side of it. And before any of it ran, we pre-registered it. That means we wrote down and dated what would count as a pass and what would count as a fail. 3 conditions and 2 words first. Expectancy is what one average trade is worth once you blend the many small wins against the rare huge loss. A drawdown is the deepest hole the account digs before it climbs back out. So, the claim survives if the realized loss stays near the advertised 2 times. Specifically, if the stop slips less than 1 extra credit on average, and the expectancy stays positive, with a drawdown you could live with. It dies if the losses routinely run 3 to 10 times instead, and the tail, the handful of worse trades at the far end, drags that expectancy to 0, or digs a hole that ends the account. That card goes up on the wall now, face out, and we settle it at the end. We don't get to move it once we've seen the answer. Claim 1, the win rate. On his own 6 names, it was 79%. On the honest universe, 78%. And across 16 versions of this test. Different strikes, different volatility assumptions, it never left the band between 76 and 92%. Claim 1 is true. Stamp it. Claim 2, first half. The average loss. It came in at 2.3 times the credit on his names, and about 2.5 on the honest universe. He said about 2. He was right. Stamp that one as well. And now, the number from the cold open, of every trade that lost while the market was open and moving normally. 985 of them, the stop filled at exactly 2 times, not near it, at it, every single time. Here is why. A disclosure about our instrument, not about the strategy. It filled at exactly 2 times because we gave it to him. In our simulation, when the price walks down through the stop level during the trading day, we assume he gets out right there, at his number, with no slippage at all. That is a gift. In a real options market, it would be a little worse than that. We handed the strategy a perfect tripwire, on purpose, because we did not want the result to depend on us being stingy. So on the numbers so far, this thing works. High win rate, confirmed. 2 times loss, confirmed. A stop that fires perfectly every ordinary time it is asked to, confirmed. That was the good news. Here's the sentence that undoes it. So far, we have only counted the times the price walked. The stock market closes. For 17.5 hours a day, and for whole weekends, there is nobody to sell to. A company reports earnings at 4:15 in the afternoon, or gets a headline at 11 at night, and the next price that exists in the world is the opening print the following morning. Your tripwire is still strung exactly where you left it. The price didn't walk through it. It was on one side at the close, and the other side at the open. There was never a moment for the wire to fire. You do not get out at 2 times. You get out where the market opens, and you find out what happened to you at the same time you find out it happened. This has a name. It is an overnight gap, the price jumping from one side of your stop to the other while the market was shut, with no trade in between. So how often? Across every trade we ran, on his own 6 names, 3.8%. On the honest universe, 4.2%. call it one trade in 24. And across 16 versions of this test, it stayed between 2.4 and 4.1% on his names, and between 2.8 and 5% on the honest universe. That rate held in every corner of the test. It is how these stocks behave. So take 100 of these trades on the honest universe. 78 of them win, most by hitting the profit target, a couple just by expiring worthless. 17 lose with the tripwire doing its job, at 2 times, exactly as advertised. 4 jump the wire. And about 2 in 1,000 limp all the way to expiry underwater, which is its own small mercy. When the price jumped, the average loss was 3.9 times the credit on his names, and 4.4 on the honest universe. The median one was under 3, which is why this is survivable for a while. The worst one was not. And these are not exotic names. Start with his own 6. Vertiv, down 20% overnight on the day an artificial intelligence story reset the whole sector, $21,900. Iris Energy, down 27%, $9,400. Robinhood, IST Space Mobile. On the honest universe, PagerDuty lost $24,000 and Impinj $18,000. Every one of those is a trade. The pitch calls a $2,000 maximum loss. Now the worst one. Confluent is a software company, and on the 1st of November, 2023, you open the 112 and collect your credit. That evening, the company cuts its guidance. The next morning, the stock opens 43% lower. Your tripwire is far above the opening price and has never been touched. At the $1,000 credit we tested, this trade is advertised to lose $2,000. It lost $55,157. 55 times the credit he collected to take the trade. 27 times the loss the pitch calls the maximum. Same trade, same rules. Same stop, correctly placed, working as designed, and completely irrelevant. Say it a third way. A winning trade pays a bit under 1 times the credit, call it $900. At that rate, the Confluent trade alone erased 60 winners. A typical jump-the-wire loss erases 4 or 5. That is the winner's erased ratio. And we owe you this one from an earlier episode. When we tested Tom Sosnoff's 11 strategies, one of them was a put ratio, the index-traded cousin of this trade. It came back with a 100% win rate over 66 cycles. We said on screen why the tail never fired, and we said we would show you what happens when it does. This is that. Note the difference. That test was on an index, hundreds of companies at once, which does not open 43% lower because one of them had a bad night. This one is single stocks, same shape of trade, completely different habitat. That's not fair. You're machine gunning trades. I wait for the high-quality setup. I'm not selling insurance the week a company reports earnings. That is the objection worth running, and it can't be settled by argument. There are 2 halves to it, and we can only run one, so here is the honest split. The first half is the names, and we can test that. We ran his own 6, the exact stocks the pitch is built on, no screen of ours at all, and the gap rate there is 1 in 26.5. That is essentially the same number. So the 1 in 24 is not something a broad universe did to him. The timing, half. Skipping earnings windows. We did not run. A caveat that cuts our way, our broad universe opens every position on the 1st of the month, which walks it straight into earnings season, and that is part of why its tail is fatter. Take those months out, and the rate is 3.7%. 1 in 27. Call the honest range 1 in 24 to 1 in 27, and we will keep quoting the conservative end. A discretionary filter cannot be tested. A written rule can. Send us the written rule, and we will run it. Fine. Then I sell further away, way further out of the money, safer strike, smaller risk. That one is worth running, because it sounds obviously right and I expected it to be right. We ran the whole test again at a much further strike, and the answer splits, so you get both halves. On the honest universe, it is worse on both counts. The jump-the-wire trades got more common, 4.8% instead of 4.2%, and the worst loss nearly doubled, from 55 times the credit to 97. On his own 6 names, it goes the other way. The frequency barely moves, and the worst case actually gets smaller. Now slow down with me, because I got this one wrong, and the reason is worth having. Further out of the money means further below where the stock is trading now, so it takes a bigger fall to reach you. That part is real, and it is the part everybody sees. But each contract that far out pays you a fraction of what a nearer one does. We hold the credit fixed at $1,000, so to still collect it you have to sell about twice as many. Same $1,000 in your pocket, about twice as much stock underneath you, and the stop is still set at 2 times the credit, which has not moved. So on the night it does reach you, you are falling about twice as fast past a stop that is no further away than it ever was. Bigger fall to get there. Far less room once it does. That is why going further out did not buy safety on a broad universe. It jumped the wire more often, and when it jumped, it was nearly twice as bad. And right now you are thinking, I would never have $55,000 riding on one company. You are right. You would have 40 of these open at once instead on 40 different hot stocks. So we ran it that way. Every trade back on the real calendar as one account. Over the whole run, gross of costs, before we have paid anybody, the account does end up ahead. It finishes $292,000 up on his 6 names and $799,000 up on the honest universe. And it makes that money walking past cliffs. On the honest universe, in the autumn of 2020, 40 of these are open at once, and 16 of them jump the wire together, because whatever gaps one hot growth stock overnight will gap all of them on the same night. Over 8 weeks, the account gives back $132,000. That is about a fifth of every dollar it had made up to that point. His own 6 names have a smaller version of the same window in early 2025. That one gave back $52,000, with 10 of them jumping together. And note the 2 clocks, because they are not the same. The honest universe ran 22 years. His 6 names have only existed for 6. That belongs on the record, because the honest verdict here is not that this loses money, and because 6 years is not long enough to have had your worst morning yet. And here's a place where we were wrong and the data corrected us. Going in, I expected running them all at once to multiply the damage. It doesn't multiply it by much. Running them all at once came out about 4% worse on his names, and 16% worse on the honest universe. The profit target closes positions in 3 or 4 days, so the book is rarely all open. The pain concentrates into crash windows. It does not compound the way I predicted. 3 questions, and we're 2/3 of the way. 1, is the win rate real? Yes. 2, is the loss actually capped at 2 times the way it sold, 23 times out of 24? 3, after the costs nobody prices, is there anything left? We haven't earned that one yet, but before we price anything, we owe you a correction of our own. Hold on, you found errors in your own data, and I'm supposed to trust the rest of it? That is the right question, and it is why this check runs on camera. We had a fake catastrophe on our own chart and did not know it. Any chart can carry one, including the ones you were shown. When we wrote up these results, the second worst trade in the entire study was Weight Watchers, in January of 2016, down 60% overnight for a loss of $42,900. It was on our chart. It was going to be in this video. It is not real. Here is what happened. Tickers get recycled. The 3 letters that meant Weight Watchers in 2016 were later reassigned to a completely different company, an insurance broker, and somewhere in the plumbing, a corporate action belonging to the second company got applied to the first one's price history. That's called a ticker collision. Every Weight Watchers price before that January is inflated by a factor of about 2.6. The stock never fell 60% overnight. Our data just changed its mind about what a share was. There was a second one, Hanesbrands, March 2015, apparently down 75%. Also, not real. That one is a stock split. A 4-to-1 split turns every share into 4 cheaper shares, and nobody loses a cent. The price divides by 4, so it drops 75% on paper. Here, the adjustment got filed on the day the split was announced, instead of the day it took effect. 75% is exactly what a 4-to-1 split looks like if you don't know it happened. So here's the challenge. Look at a price that fell 20% overnight. Is that a crash, or is it a 5-to-4 split nobody told you about? You cannot tell, not from the price. Watch the arithmetic. 4-to-1, the price divides by 4, down 75%, nobody lost a cent. 5-to-4, every 4 shares become 5, so the price divides by 1 1/4, down exactly 20%, and nobody lost a cent. And 20% is also the single most common size of a real earnings crash. Our first version of this check caught fakes by their shape, and it accused 2 of our most important real trades, Vertiv on the artificial intelligence sell-off, and Coinbase on the day the yen carry trade unwound. The shape test doesn't work. You have to get the corporate action record and check. So we did, for every trade in the tail. That is the whole list. 2 fakes out of 65, every trade in the tail that moved worse than 10%. And note which direction we looked, down. An error that inflated a winner is one this screen would not have caught. Now the part that matters. Both of those fake trades were losses, so throwing them out moves every number in this episode in the seller's favor. We did it anyway, and then reran everything. The worst real loss in the base test is unchanged, at 55 times the credit. The account's worst drawdown is unchanged, to the dollar. The 1 in 24 did not move at all. The gross edge got slightly better for him. And all 16 versions of the test still come out positive. And this is the part 16 different sets of assumptions could not move. In every single one of them, the worst trade in the entire honest universe is the same real trade, Confluent, that November morning. 16 different sets of assumptions, and the tail keeps pointing at the same actual company on the same actual day. That is what it looks like when a result is about the market and not about your model. So the tail is real, and the tail is his, which leaves the one thing we still have not priced. Commissions? Come on, that's nickels. Nobody blows up on nickels. 985 times the stop held. 234 times across the whole run, the market was shut when it mattered and there was no stop to hold. That was question 2, and it is settled. Now question 3. Everything up to here has been gross, that is, before costs. And gross is how this trade is usually presented. A recap has nowhere to put the 1 in 24. It has nowhere to put this either. Count the legs. 1 long put, 1 short put, 2 more short puts, 4 legs to open, 4 legs to close. And this is not one contract each. To collect $1,000 of credit on strikes that far out, you run 15 or 16 at a time. Call it 125 contract fills every round trip, roughly once a month. Each one costs you 65 cents, a normal published retail rate. That is about $80, charged whether you win or lose, and commission is only the first cost. The second is the bid-ask spread, a different spread from the one in this trade's name. It is the difference between what a buyer will pay you and what a seller will charge you, and you cross it on every fill. On puts that far out of the money on a volatile stock, that toll is a large fraction of the credit you are collecting. Together they are the 4-leg tax. Start with the honest universe, and on the same terms we will use for his names in a minute, the trades a real book would actually take. Before any cost at all, the average one makes $169. Now charge it the commission. Nothing else, just the fills, and that $169 falls to $89. Commission alone takes about half. Then the spread. What you lose to it is called slippage, the difference between the price you aimed at and the price you really got. Give up 3% of the premium you transact on every fill, and the trade goes to minus $7. Give up 5, and it goes to minus $70, 10 times deeper. And if you count every trade instead of just the ones worth taking, the honest universe is worse, not better, minus $16 and minus 80. 3% is ordinary on an option that trades all day, and generous on these. These barely trade at all. The gap between the two prices is wide, and you cross it on every one of those fills. That is question 3 answered. On the honest universe, no, there is nothing left. Now, minus $7 is not a landslide. The direction is unambiguous. Every honest cost you add moves this towards 0 and past it, and by the time you assume a spread cost that any options trader would call realistic, the honest universe is clearly negative. Run the same cascade on his own 6 names, and a thin sliver survives. $82 a trade. And there is a choice behind that number made in his favor. We priced costs on the trades a real book would actually take, a credit of at least $20 per lot, because a $5 credit is swallowed whole by commission. That drops a third of his trades. Count every trade instead, and his names come out at minus $81 too. We are quoting the version that treats him best. And now the limit of this study. We did not have historical option prices. We modeled the option legs from real stock prices and real volatility. That cuts 2 ways, and it is not symmetric. The size of the edge depends on our pricing model, which is exactly why we ran 16 versions instead of quoting one number. The size of the disaster barely depends on it at all. When a stock opens 43% lower, what those puts are worth is mostly just the size of the move, not anybody's volatility assumption. The trustworthy part of a modeled test is the disaster. The soft part is the profit. The card comes down, and we read all of it, including the part he wins. We wrote a specific test for the word capped, that the stop slips less than 1 extra credit on average. It does. It slips about half a credit. On the average, his stop passes our own pre-registered test. Where the card fails him is the second clause. It said, the claim dies if the tail drags that expectancy to zero, and once you price the costs on the honest universe, it does. It also said the losses would routinely run 3 to 10 times. That one is half true, and I will give him the half. When a trade jumps the wire, the average on the honest universe is 4.4 times the credit, but the median is under 3. The fat part is rare, not routine. It is still the part that ends you. That leaves the third clause, the drawdown that ends the account. I can't settle it. We ran profit and loss, not a funded account, so I cannot tell you the morning a broker issues a margin call, demands more cash against those naked puts and closes you out if it isn't there. That is the mechanism that actually ends accounts, and we did not model it. What I can tell you is that the book gave back a fifth of everything it had made in 8 weeks, with 40 positions open. So, the verdict is split. The risk claim fails on every configuration we tried. The expectancy claim survives gross and fails only once you price the costs. And on his own 6 names, the list that flatters the strategy by construction, it does not even fail then. So, to one specific person. If one bad morning on one position can take $55,000, then the account that can absorb that is not the account this is being sold to. And you cannot fix it by trading smaller, because, at a credit small enough to be safe, the income is not worth collecting and the commission eats it anyway. That is the person this changes. If you are running the single stock version of this for income on a retail account, it is not income. It is a bet on the exchange staying open. And the sizing lecture in Tom King's recap is correct. Feed correct sizing arithmetic. A wrong maximum loss, and it hands you a wrong position every time, in the direction that ends accounts. It wins most of the time. I told you, 4 out of 5. True, 78 and 100, and we showed you why it has to be. The average loss is about 2 times what you collected. True, and it slips less than our own pre-registration allowed it to. So your loss is capped at 2 times every single trade. False. 1 trade in 24, it isn't capped at all. So the math is on your side, and it always was. That's just arithmetic. Only before costs. Price them, and on an honest universe there is nothing left. This is a rarer thing than a bad strategy. Every number in the pitch is defensible. The win rate is real. The average loss is real. The gross profit is real. And the product is still missold, because the 2 numbers that decide whether you survive it are the 2 that never appear. What it costs to trade 4 legs, and what happens the one time in 24 that the market is shut when it matters. $2,000 is the number on the pitch. 55,157 is the number in the data. Both describe the same trade. The root cause is boring. It is 2 things, commissions and the fact that the stock exchange closes at 4 o'clock. That's it. That's the whole autopsy. No villain, no fraud, no secret. Why do smart people buy this? 3 reasons, and none of them require anyone to be lying. 1. The strategy wins most of the time, so the evidence of your own account agrees with the pitch for months. 2. The stop takes every ordinary decline we hand it. We gave it a perfect fill 985 times, and it took all 985, so real experience confirms the belief constantly. 3. The event that breaks it is rare enough that an honest trader can post honest monthly recaps for most of a year and never have one, and that includes the person selling it. His own track record is the same sample ours is. Survivorship bias applies to your own results too. It is the hardest version of it to see because the sample is you. Nobody has to be dishonest for this to keep being sold. The recap is true. The month is real. 7 is just a small number. And the incentive chain, numbered and without accusing anyone. 1. A strategy that wins most months produces good-looking recaps. 2. The recap ends with a discount code for a paid room. That is the format, and it is disclosed, not hidden. 3. The event that would correct the story shows up about once every 24 trades. At 7 trades a month, that is about 3.5 months of honest, clean-looking recaps between corrections. 4. Nobody is required to price the spread, because no rule says a recap has to. So, directly, your stop is not a wall. It is a tripwire, and it does not work when the market is closed, which is most of the time. What survives? The win rate is real, and now you know why, which is worth more than the number. The stop does work on an ordinary decline, and that is not nothing. And gross of costs, this trade did make money over the whole run. The edge is not what fails here, the capped loss claim is. So take one question with you, and it works on every premium selling strategy you will ever be shown, not just this one. Not, what's the win rate, not what's the average loss. Ask, what happens the time the stop doesn't hold, and how often is that? If the person selling it hasn't measured that, they haven't measured the strategy. They've measured the weather. And this pattern is on your feed right now wearing a different name. Any structure that sells you a high win rate and a defined loss, where the defined part depends on being able to get out, gets the same question, and it gives you the same answer. Here is what would change our mind, and this is a live bet. Give us a mechanical rule, not discretion, a rule that skips the earnings windows or the gap-prone names, cuts that 1 in 24 below 1 in 100 and still comes out positive after commission and the spread. We will run it, and if it holds, we'll say so in a video. Or show us real historical option prices, where the gap morning fills are better than we modeled. Our pricing model is the weakest link in this study, and we would rather you broke it than we defended it. Everything you would need is already published, dated before the results, as always. That's where the record stands today. 78 trades and 100 win. We handed the stop a perfect day 985 times, and 985 times it held. About 1 time in 24, none of that is the part that matters. And on an honest universe, after the 4 legs and the bid ask, what is left, rounds to nothing. This is ground truth. The machine is always hungry.